Everybody wants to know if the current market volatility is it. Is this the big one that we've been waiting for? Well, what we've really been experiencing is what happens when there are a lack of buyers, since the buybacks were frozen during earnings season. The big question is this it? The answer lies in ETF stock clustering, the algorithms, and corporate liquidity. Coming up. Hi everyone, I'm Lynette Zang and welcome to ITM Trading. And today we're going to look at a really significant question. Is this it? Is the current market correction, where you've got a lot of the sectors that have entered not just correction territory, but bear market territory, and the volatility with these indexes moving hundreds and hundreds of points within a very short period of time. Is this one it? Well, we do know that right along, Wall Street has been given quite a few opportunities to support the markets, and corporate buybacks are certainly a big part of that, and in fact were the last thing supporting the market as it was making rises to new highs. And then of course the end of January hit, and even though we had a new high on October 2nd, it was really just very, very short-lived. So what we've really experienced is this lack of buyer. And we've been talking about the shrinking buyer base. And so today we need to take a look at the corporations and the tools that they have. And I thought that we might take a look at Apple, because that's much in the news now that hit a new high, first U.S. company to hit $1 trillion in valuation. Well, as the rise of the ETFs occurred, and all of those ETFs were buying Apple stock, well, it helped them on the way up. And when you couple that with all of their buybacks, well, now that makes it an even more clear picture on why Apple was on a tear and became the first company to hit $1 trillion. But at the same time that that's been happening, what do we see? We see the insiders, those at the top of the corporate ladders. So your boards of directors, your CEOs, your CFOs, etc. We see them selling into this. And we certainly know that that is a tool that has been used, particularly since corporations were no longer held liable for insider activity when they bought back their stock. We've certainly seen that used quite a bit since then. But we also need to take a look at what happens on the way down. Apple in particular, you have over 61%, almost 62% are institutional holdings, which actually doesn't sound that bad, except those institutions are investing other people's money. So that would be the ETFs, the mutual funds, things that are inside of variable annuities, so pension funds, IRAs, and that's who's really sitting and holding this. Well, what we've seen is a lack of selling, which means that people are they've gone to the sidelines with it. But what happens when selling picks up? If this volatility continues and these markets continue these wild swings, when people open up their next quarterly statements, they're going to notice something. Maybe they aren't looking at it every day right now, but when they look at that statement, unless that statement looks somewhere reasonably near where it looked the last time, they're going to start to get more nervous. And all this volatility are making those that are paying attention a whole lot more nervous. But as we looked at the ETFs just the other day and that clustering effect and how they make it appear that there are a lot more shares on the market as they're in the buying mode because they're really just derivatives. Well, now what we could be seeing is the start of what happens in that selling mode, because really this is how ETFs are created, via demand. So if people are wanting to invest or short or whatever people are wanting to do where they perceive that they want to do, well, these ETFs are just created just like that out of thin air to meet all of that demand. But they're destroyed when it's time to sell them. But not by you or me, because they do not pay you out in cash. They don't hold any cash. We looked at that. They pay out in kind, but not to you and not to me. They pay out in kind to whoever you bought that ETF through. So it could be, JP Morgan, or it could be Bank of America or Blackstone or any of those guys. And as long as they can keep that covered up with cash, what they get to liquidate are they may have the ability to take possession of the underlying shares. And if they can hold them, they will. But if they can't, if there's enough demand for liquidating their positions, then the opposite holds true. And because you've got 90% of these markets that are simply algorithmic or computer-based parameter trading, when a certain level is breached, there's a computer there, the formula that bam, it just goes off. So that means that what now is a correction, even entering into bear market territory, you could see it a whole lot worse. So if the buybacks, and I got to tell you, regarding Kramer, he has now been talking about how this reminds him of 2007. And he's been talking about how the behavior of the central banks are the same that he witnessed in 2007. And he definitely reminded everybody this morning that he has a much better track record than the central banks. Well, the central banks are actually never right, because even if they were right behind closed doors, they cannot come out and really tell you truthfully what they see and what their concerns and fears are, because if they did, everybody would make different choices, and that would simply make those fears and the runs happen a whole lot faster. So, part of what we have to look at is the central bank capacity to act as lender of last resort. And will the central banks here, I'm going to be looking at this next week, but will the central banks here take a nod from the Bank of Japan and Japan's government, because they're now in the last 3 decades, and all of that QE money printing, even going into negative rates, even owning most of their stock market, it's made it more like pushing on a string. And the corporations, this is a breakdown pattern. So once the markets were breaking down in 2015, and you might recall a lot of that had to do with, in 2015, it was the whole monetary peg system that began its breakdown in this iteration. So those are the 2 videos that I think I'll do next week. I've been wanting to do one on the peg system breaking down. So that started in 2015, first with the Swiss surprise and then with the Chinese surprise. And the markets themselves were really struggling and breaking down. And what did the central banks do? A lot more QE. But they're trying to wean the world off of that. And they're trying to, well, in this country, they are raising the rates. And so all of this corporate debt that has supported so many of those buybacks, you know, it doesn't look like they're there. So we'll have to just take a look at it. Can they do another big push? The pattern of it looks very, 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 very different than what we've seen in this whole ride. And I don't personally think that they will have the ability to do that. So is this it? It is quite possible, because all of this is systemic risk. Even margin risk, when you've got margin levels at the highest level ever, with the stock markets this volatile and up one day, down the next, I'm going to tell you, you are likely having margin calls. I'm sure of that. I'm sure that that has to be breaking down right now too. We just can't see it yet, but we can feel it. And we can see it in the volatility. So will the central banks come to the rescue? Well, I think we should look and see what the smartest guys in the room on all of this are doing for themselves. And we can see this because this is the central bank crisis plan. And they are laying in through the third quarter of this year, 22% more gold year over year. But even more important than that, the base of buyer is growing because you have more and more central banks that are now accumulating gold in their reserves. Why would they do that? Because it has no counterparty risk. Physical gold runs no counterparty risk. Where all of this other stuff, all of this these Wall Street products, are all counterparty risk. So if this is indeed the last hurrah, and it might be, I mean, I can't tell you that they're not going to find something else to push these markets up. Where is all that dry powder? Or maybe the corporations just won't throw good money after bad. And we have to look at the impact of even GE on the junk bond market, which we already know is in a hugely precarious position. So what do the central banks do? They buy gold. That's their crisis plan. This is my crisis plan. Here you go. Physical gold, physical silver in my possession, out of the system, just like they hold theirs. JP Morgan's doing the silver, the central banks are doing the gold, and the 1%ers are doing the collectible gold. What category do you want to be in? I have to tell you this too, because we have an event that's coming up that I'm really, really excited about. The timing on it maybe couldn't be better. It's in February 8th and 9th. There, we've set the link up so you can go in. It's itmtradingevents.com. You have to have the www in front of it. But I have to tell you that this is really actually a workshop, and it's the most comprehensive information on the strategy that I have personally ever put out there. This is designed specifically for strategic investors that are ready to create and execute a strategy for themselves. And honestly, the sooner you create that, the better off you're going to be. So if you want more information on it, go to www.itmtradingevents.com and take a look. There's more information there, and I'll be talking about it. But I'm really excited about it. It's really going to test me, but there's going to be a lot of value in here by the time, if you come to this event, it is a 2-day event. If you come to this event, by the time you walk out that door, you should have your strategy and be able to start to execute it. So after that, we just released Reluctant Preppers, and I really enjoyed that video, creating that with Dunnigan, as always. So that's out. And next week, we're going to do a minute to midnight, and we're going also to look at some things about the oil and the petrodollar. So I hope you be safe. We're going into a holiday week, and I want everybody to be safe out there. At least in the U.S., it's Thanksgiving, but everybody can celebrate. It doesn't really matter. A party's a party. And until then, keep in mind that shields are made of metal, not paper, not promises. And definitely, if you have not yet begun, or wherever you are inside of the process, keep in mind it's food, water, energy, security, barterability, wealth preservation, shelter, and community. Please be safe out there. Bye-bye.